Welcome to Phillip Futures webinar series. My name is Lynette Tan, Senior Investment Analyst with the investment team. Today, our webinar will examine the key events and factors that can affect gold price performance for the rest of 2012 and for the first quarter of 2013. Before we begin, please be informed of our disclaimer. Do note that the information presented in this presentation is for investor education purposes only and does not constitute investment advice in any manner. Some key themes that we are looking at today includes the US fiscal cliff, an important event that will determine the fate of the US economy for the coming year, and how this event will affect gold price. We will also take a look at the effect of quantitative easing on gold. Next, we will go on to discuss the demand outlook for gold, primarily focusing on consumer and investment demand, and then go on to look at the trend of central bank gold purchases. Let us first do a review of how gold has performed this year. Year to date, gold price is up about 9%. Gold started the year at around $1,552 an ounce and traded the lows of $1,523 towards the middle of the year, after hitting the 2012 high at $1,790 in late February. The key resistance of $1,790 was tested again in September, when prices ran up almost 15% after Federal Reserve Chairman Ben Bernanke announced the launch of QE3 in September. We saw some price correction in October when overall market sentiments were pessimistic due to worries of the fiscal cliff. Gold is now hovering around the 1,700 levels. Judging by the safe haven qualities of gold and its use as a hedge against depreciation of fiat currencies, we are optimistic that gold will make its 12th year of bull run this year. Let's first take a look at what is exactly this fiscal cliff event that is sending jitters through the market at the moment. Fiscal cliff is the popular shorthand term used to describe two events that are scheduled to occur that many fear will pull the US economy into recession. One is the expiration of Bush-era tax cuts, which will increase income, dividend, estate, and capital gains tax rates for a substantial majority of American taxpayers. The other is mandatory cuts to domestic and military spending programs that were agreed to as part of the congressional debt ceiling negotiations last year. The ongoing fiscal cliff is a concern for investors since the highly partisan nature of the current political environment could make a compromise difficult to reach. As expected, we are less than a month away before the tax hikes and budget spending cuts kick in, but the US lawmakers are seen to make little progress over the negotiations. Although both sides of the Congress have spoken about finding a compromise, both parties stand rigidly committed to their key beliefs. The Democrats think taxes need to be raised on the wealthiest Americans to bring down the budget deficit, while Republicans continue to oppose raising taxes on the wealthy and favor cuts in programs such as Social Security, Medicare, and Medicaid. We think that the most likely result is another set of temporary measures that will delay a more permanent policy change until the first half of 2013. There are a number of possible scenarios that could happen for the coming fiscal cliff. Firstly, the deep divide over spending and taxes between the Republicans and the Democrats has caused them to reach temporary deals that keep the government running while pushing off most of the big decisions on financial policy. They could always do it again. The most likely deal will extend the current tax cuts and spending levels for a few more months, while raising the total amount the government can borrow as negotiations continue. The problem with this approach is that it obviously solves nothing. The uncertainty that continues will keep the financial markets trading in a seesaw manner and make it hard for businesses to make long-term plans. Federal budget deficits would also continue to swell. The extreme scenario is, of course, that US falls over the cliff. Payroll taxes will jump. Capital gains and income tax rates would also revert to higher levels. Overall, a typical middle-class family of 4 would see its taxes rise by $2,200, according to a recent White House report. At the same time, the first round of $1.2 trillion in budget cuts spread out in equal amounts from 2013 to 2021 will go into effect. Over the long term, the combination of tax hikes and spending cuts will strike hard at the economic recovery. The Congressional Budget Office projects that going over the cliff will push the economy, now growing by about 2% a year, back into recession for the first half of 2013. Unemployment, now just under 8%, will climb back to 9.1%. Economic growth will return in the second half of the year, yet the US economy would shrink by 0.5% for the year overall. Even if the recession is relatively brief, the budget cuts and tax increases will mean more hard times for millions of Americans. The third outcome is to successfully reach a long-term deal between the Republicans and Democrats. What would the deal look like? It would almost certainly include some tax increases. President Obama favors keeping income tax rates where they are for those making less than $250,000 a year, but taxing the rich. The capital gains rate would also increase from 15% to 20%. Some combination of higher rates and fewer tax breaks seems the obvious compromise, so both sides would be able to bring something back to their supporters. The final balance that negotiators strike will not only determine federal spending, but also the extent of the government safety net for the near future. Whichever the case, we'll know where we stand in less than a month. In September this year, the Federal Reserve said it will expand its holdings of long-term securities with open-ended purchases of $40 billion of mortgage debt each month in a third round of quantitative easing. The Fed chairman Ben Bernanke is enlarging his bag of unconventional tools to attack unemployment stuck above 8% since February 2009, a situation he called a grave concern. By lowering borrowing costs and spurring banks to lend more, the Fed hopes to induce more spending and eventually set the stage for more hiring. This time around, the Fed tied its bond purchase program explicitly to jobs, saying it will keep buying bonds until it sees a substantial improvement in the labor market. The effect on QE is largely supportive, as gold provides investors an avenue where they can store wealth in the face of a depreciating fiat currency. This graphic provided by Reuters shows the performance of different assets on the back of QE1 and 2. Green-colored boxes represent positive returns, whereas the warmer colors of yellow, orange, and red represents different degrees of negative returns. Focusing on gold, we see that gold gained between 20 to 48% over the lifespan of QE1 and 2. We were proven correct again in September this year when Ben Bernanke announced QE3. Looking forward, we are bullish on gold in the long term. QE3 has given gold a launching pad, with the last QE having an infinite deadline until unemployment is at satisfactory levels. The situation thus paints a very rosy picture for gold. A look at the price performance of gold in previous quantitative easing gives us an idea of how prices are supported from its launch till the end of the year. With an average increase of around 18% in QE1 and QE2, we can expect gold prices to probably hit a high of around 1,880 this year. This means that gold will breach 1,800 reached in February this year, but probably not hit its lifetime high hit in September 2011 at $1920 an ounce. However, if the fiscal cliff is temporarily averted, we are likely to see markets in a risk-on mode and dollar strength to limit jumps in gold price. After discussing the important events that will affect gold prices, let's examine the demand outlook for gold. This pie chart breaks down the percentage of gold used in different sectors. Over here, we see that jewelry demand constitutes about 1/3 of total gold demand, and investment demand, represented by the green portion, constitutes another 1/3 of it. Let us start by looking at the bar and coin demand. The dotted black line represents the 5-year average, and we see clearly that since the second quarter of 2010, demand for this segment has been performing above the 5-year average. An interesting point to note is that as gold price maintained around the $1,600 levels in the last 1 year, demand for bar and coin has correspondingly dropped as well. Dwelling deeper, we see that most of the growth in bar and coins is coming from emerging countries such as China and India. In Europe, US, and Turkey, the faltering economy could be one reason for the declining physical gold demand. Another likely reason could also be due to the decline in popularity of buying physical gold and increasing popularity of holding gold through ETFs. Cultural affinity with physical gold is also possibly to a lesser extent compared to the Asian countries. Next, we move on to investment demand for gold. The dark green bars here denotes bar and coin demand, whereas the light green parts represents ETFs and similar investment products. You can clearly see that the trend for the last 3 years, bar and coin demand has been waning, falling from 86% to 83%, and a larger drop this year by 15%. On the other hand, paper products for gold investment have almost doubled from 17 to 32%, largely due to support from quantitative easing. Quarter 3 jewelry demand was up from the previous quarter. Declines in China, Saudi Arabia, US and European markets contributed mainly to the decline. This was due largely to the strong rise in gold price towards the end of the quarter. India alone accounts for 30% of global jewelry demand and was surprisingly the strongest performing market in the third quarter this year. Now, let's take a deeper look at the two biggest gold markets, India and China. Historically, India has been the largest gold consumer, but in recent years, due to increased taxes and a weak rupee, China has emerged as a likely competitor for the top spot in gold consumption. Regionally, India and Greater China demand remain robust, particularly compared to their 5-year averages. Their share of the physical market has grown, due partly to faltering demand from other regions, especially Europe. We expect this trend to continue, especially from China, as the country steps up their effort to expand the gold markets through various ways. China's gold appetite can be seen from their increased gold imports from Hong Kong, especially in the last 2 years. Moreover, China also sought to buy gold as a diversification measure for their foreign reserves. Although the country remains a strong buyer of US debt, the percentage of dollar holdings in China's foreign exchange reserves fell to a decade low of 54% in June 2010. On top of this, China also reached out to accumulate gold in other ways. Given a small physical gold market and supply of gold mined each year, Pursuing quality mining assets is a strategy the country is adopting. Commenting on the recently announced bid for African Barrick Gold Limited by state-owned China National, CEO Sun Zhaoxue stated, "As gold is a currency in nature, no matter if it's for state's economic security or for the acceleration of renminbi internationalization, increasingly, the gold reserve should be one of the key strategies of China." If the acquisitions succeed, state-owned China Gold, the country's largest gold producer, will join a string of domestic gold producers that have ventured overseas in the last 2 years. In September, Chinese and Venezuelan officials signed an agreement to jointly develop one of the world's largest gold mines. The agreement to develop La Cristina's gold mine was signed by officials of the Venezuelan government and the Chinese company China International Trust and Investment Corp. What happened? Oh, I need to drink water. I start again for this part. In September this year, Chinese and Venezuelan agreed In September this year, Chinese and Venezuelan officials signed an agreement to jointly develop one of the world's largest gold mines. The agreement to develop La Cristina's gold mine was signed by officials of the Venezuelan government and the Chinese company China International Trust and Investment Corp, or CITIC. The mine in southern Bolivar state has been estimated to hold about 17 million ounces of gold. President Hugo Chavez called it an agreement to begin exploiting both gold and copper deposits at the mine. He called La Cristina's one of the biggest reservoirs of gold that exists, not only in Venezuela, not only in Latin America, but in the world. Therefore, we see that China will play a big part in driving continuous demand for gold via its retail segment, investment demands, and for the diversification of forex reserves for their central bank. Next, we look at India, traditionally the largest gold consumer in the world. China outshone India, Next, we look at India, traditionally the largest gold consumer in the world. China outshone India, the unmistakable leader in gold demand, for the first time during the fourth quarter last year. Overall demand in India declined 42% to 173 tons in the fourth quarter of 2011 as compared to 298.6 tons in the corresponding quarter of the previous year. This has raised concerns that India may not be able to retain its top position as the world's largest gold consumer. On top of this, the Indian government has introduced a number of policies to cool demand for gold as gold imports has swelled the current account deficit of the nation, causing concerns for the Indian government. Other than increasing a number of taxes on gold purchases, the Reserve Bank of India in November notified a total ban on banks from advancing any loans to its customers for purchasing gold in any form, including gold bullion, jewelry, gold coins, and gold ETFs. These tax increases, along with the weak rupee that has pushed up local gold prices, may contribute to further declines in Indian gold demand. As seen from the graph, jewelry and investment demand for gold in India has been declining in the last year, whereas China has enjoyed a simultaneous increase in gold demand, as shown by the dark green bars. However, not all is lost for India's gold demand, as physical demand may have given way to some increase in paper gold products such as exchange-traded funds. The asset under management for India's gold ETFs has indeed increased in the last 2 years, but do note that despite a rise in the AUM, this market is still considered very immature compared to the established gold ETFs in the global market, such as the Spider Gold shares. Tonnage of Indian gold ETFs is only 12, which is negligible compared to more than 1,000 tons held by the benchmark of Spider Gold Trust. To conclude this section, we see that Indian demand for gold may languish, but not by a drastic level. We think that the strong cultural affinity to gold will ensure a steady support for gold purchases in India, despite rising local gold prices. The decrease in physical gold demand may also translate to higher investment buying in the near future, and lastly, gold remains a viable savings tool and store of value for India due to its limited investment options. In our last section, we will look at central banks' demand for gold. The data in this slide is taken from the World Gold Council, reflecting the year-on-year changes in demand for gold from 2010 to 2011. As highlighted by the blue box, we see that the official sector purchase, which also means central bank purchases, increased a stunning 492% within a year. As seen from here, central banks have traditionally been net sellers of gold, and this trend has reversed since 2011, where the official sector became net buyers of gold. According to a report by Thomson Reuters GFMS, a precious metals consultancy group, central banks will increase gold purchases to 493 metric tons this year, as they keep expanding reserves to diversify from the dollar and a quotation. According to a report by Thomson Reuters GFMS, a precious metals consultancy group, central banks will increase gold purchases to 493 metric tons this year, as they keep expanding reserves to diversify from the dollar and a potential gain in inflation. The banks bought 273 tons in the first half of 2012, 34% more than a year earlier, and will purchase 220 tons in the current half to raise the full year total by 7.9%, the London-based researcher said in the report. Fueling the rise in official sector interest in gold is the anticipated future depreciation of the US dollar and the continuing erosion of its status as the world's official reserve asset. The dollar is not the only currency suffering a loss of respect. With the Eurozone crisis dragging on for years, a loss of confidence in the euro as a reliable reserve asset is not a surprise as well. Central banks are thus creating an upside bias to the market with their huge demand for bullion, and as a consequence, we can expect less downside volatility. This will create a more sustainable bull market with much higher prices in the years to come. After looking at the fundamental factors supporting the gold market, let us now look at the technical analysis of spot gold. Shown here is the daily chart for spot gold. We use the MACD indicator at the bottom of the chart to show the short-term trend of gold. With the MACD crossing down the signal line and going into negative territory, gold may be due for a downward movement. This bearish view is also seen where the last red candle had broken through the lower band of the blue Bollinger Bands. If the next 2 to 3 trading sessions continue to break outside or trade along the lower Bollinger Band, we may see a sustained downtrend towards the end of the week. We also see that the last red candle have broken out of the uptrend channel, denoted by the black dotted trend lines. This upward trend channel has sustained for the last 1 month since the start of November, and if we do not see prices trading up above the trend line in the next few sessions, we can expect to see a correction to the past month's bullish trend. Lastly, our support for gold is currently held at the $1,680 level, as indicated by the purple 200 period moving average, which we have found to prove a very reliable support level for gold over the long term. To conclude today's webinar, let us summarize our key points. Our overall outlook for gold continues to be bullish, and we are confident for gold to end 2012 on the 12th year of bull run. For now, till the first quarter of 2013, we expect 3 key factors to underpin gold price movements: increasing consumer demand from China, sustained central bank purchase, and physical demand from India to decline slightly, but for ETFs to possibly replace some of that demand. With this, we thank you for your attention and hope that you have found today's webinar helpful for your understanding of the gold market. I'm Lynette Tan, Senior Investment Analyst with Phillip Futures. Stay tuned for more of our webinars. Thank you.